Hello and welcome. Gallantt is in focus on the back of its Q4 results today. The company reported a 8% of a revenue growth this quarter with increase in its production. Meanwhile, its sales realization remained under pressure with about 12% dip here, continued with a lower input cost. Now, if you look at EBITDA, EBITDA saw about a 49% jump with its margins moving upwards at 15.8% compared to 11.4% last year's quarter, and net profit saw about a 40%. But to discuss more on the quarter and the fiscal year gone by, we have Mr. Mayank Agarwal, the CEO, joining us. Hello and welcome to the show, Mr. Agarwal.
Hi, good morning, ma'am, and good morning to all the viewers.
So my first question is on the Q4 and the overall FY24. How did the quarter go by? Can you point out the key highlights that were for the fiscal and the quarter which went by for the year?
Ma'am, the results are really interesting and we are very excited to inform all of you. If we compare it to quarter versus quarter, the production capacity, the total production has increased by 9%. And if we talk on a year-on-year basis, it is about 7%. And even the revenues have increased by 4% and 8% respectively. While it is to be noted that the sales realization has dipped down to about 10%, even on quarter basis, and 12% on yearly basis. So despite that, there is a jump in the revenue of 4% and 8% respectively. And besides that, even the EBITDA is very strong, 24% on a quarter-to-quarter basis, and 49% on a quarter-to-quarter basis, and 24% on year-on-year basis. So the profit is also extraordinary. If we compare it to the quarter last year, it is about 59% jump, and if we talk about year-on-year basis, it is about 30% jump. So overall, the performance of the company is extraordinary, and we are really excited to have posted these results, and it shows our dedication and performance, and we are gearing up for the next year now.
Okay, so just on the next year part now, if you have to look at the overall industry trend, we have seen some volatility in the iron ore prices, especially with the weak macros pointing out in China. I just want to understand, how does this impact you, and what does this set as a trend for you going forward in FY25?
See, the raw material has definitely been volatile, whether we talk about coal and whether we talk about iron ore. And however, I believe that the volatility would be lesser in the next financial year, mainly due to the volatility had increased due to various dynamics, global dynamics, which changed because of COVID and afterwards. So despite the volatility, we were able to post such impressive results. So we are totally built up and buckled up for this in the future as well. And it is also, I would like to share that the company has also announced today to provide 1 rupee per share, that is 10% of the face value, as a dividend. And this dividend was to be given to all the shareholders, including promoter shareholders, but promoter shareholders have waived off the taking of the dividend, and the company is withholding that amount to be utilized in company's expansions. So the dividend would be going only mostly to the non-promoter quota.
Mr. Agarwal, I'll definitely touch on the expansion plans in the future questions, but more on these macros over here, when do you expect the stabilization to happen? Can we expect this trend happening in the first half of the 2025 itself? Because that would also mean with the revenues now shifting focus, and we'll expect more revenue growth forward in FY25. And if yes, what is the kind of revenue growth are we looking at in fiscal year 2025?
So currently, I would say the fluctuations are already in the level of about 10 to 15%, and it is not as much as we have seen it in the past. And it's more or less already stable, if we talk about thermal coal or whether we talk about iron ore. And if we specifically talk about the company as to how the company is going to be in the next financial year, so we were undergoing about 100 crore of capex in the last couple of years, 3 years. And now all of that is already implemented, besides leaving aside one 500 TPD 2 lakh ton plant of DRI at Gorakhpur, which is under commissioning with an investment of 150 crores. Even in the current financial year under review, we have commissioned pellet plant in July itself. And even currently, despite approximately 10% of increase in the production, our capacity utilization stands at 85%. So the next financial year, from the company's perspective, we are looking at a quantitative growth as well as the impact of the complete financial year of the pellet plant under which has been commissioned in July. That was half year gone by the time it's stabilized. And also we plan to commission this DRI kiln by December. So all this would be adding to the profits and the better realizations of the company in the next financial year as well.
Can you put a number on this, the revenue growth and the profit expansion that you're seeing for the next year?
So putting a number would be difficult, ma'am. It all depends on the market supply and demand forces, and also what realizations and what competition is there. But I assure through you, I assure to all my shareholders and to all the people in the financial market that we are all buckled up for a better performance in the next financial year, and you will definitely see much better results than the current year as well.
All right, definitely. Moving on from this now with the commencement of the pellet plant at Gorakhpur, which is expected to bring down the cost along with the recent acquisition that you have made with the railway rakes which has led to better logistic costs for the business. You did mention that the margins are expected to be in the 13% range by FY26 compared to about 11% that we have clocked in this year. But we have taken a lot of initiatives in FY25 itself. So what is the kind of margin improvement, or rather in basis points, or at what margins are we looking for this fiscal year, that's financial year FY25?
So actually when the pellet plant was commissioned in July, so if in the current financial year you see the capacity utilization is hardly 58%. So we plan to ramp it up to at least 80% in the next financial year, which will majorly add to the margins and margins of the steel making.